Hey guys, this is Andrew Keen from KeenOnTheMarket.com. I want to talk about two trades today, okay? And I'm going to show you guys how I made money here. And this was a pretty, simple task I saw to make money today. Okay, so one of them was an SFM. I saw an order going across the tape in Sprouts Market. Uh, and what I saw going across the tape was a trader bought 1855 SFM, no 50 calls for a buck. Okay, this is an opening position. I always like to see opening positions. Okay, the first thing I look at is, okay, bullish activity, right? That's great. And I look to see how much volume the stock usually trades in a day. Buying 1,800 calls, might not be a lot in Bank of America, but in a stock like SFM, right, it controls 180,000 shares. The stock only traded 180,000 shares today. So it controls 1 day's volume today. So I went in here in SFM and I looked at the no 50 calls. They were 85 at 105. And I was trying to pay a buck. I didn't get filled. Okay, let's pay up another nickel. I paid 105 for these, okay? And then I started selling them out, 135 and 155, okay? When you guys are trading and I'm trading, okay, the goal is to make money. I always say the number one goal is to have fun. Number two goal is to make money, okay? Number three is to manage risk. I don't want to hold these no 50 calls to expiration, okay? They're $2.50 out of the money. The stock has to move up $3.50 for these to get to break even, okay? I want to buy these when they are buying implied volatility. If an institutional hedge fund's buying implied volatility, then I want to buy it with them, okay? So I bought 18 of these calls for 105. Look, I already took profit target, 135 and 155. So I sold 8 of them at 145 total, which is $1,160, and I was risking about 1,800. So I only have $600 of risk left, and I have 10 of these left, okay? So you can look at it as a couple different ways. You can look at it as, hey, I took profits, or you can say, hey, I lower the cost basis on some of them, okay? Another one, QSII, okay? Huge order came in today. Sometimes I have to react really fast to these trades, okay? These markets move a lot. Huge buyer, 3,600, QSII, D's 22.5 calls, okay? So when I looked at this, it trades about 500,000 shares in a day. So this trader gives the right but not obligation to buy 3,600 calls, 360,000 shares of stock. So what did I do? Okay, hey, let's go in here. Let's buy some QSII these quarters. So I jumped on board and I bought these for 70 cents. You can see I paid 70 cents. And I bought 15 of them. So 15 times 70 cents is $1,050. Okay, I already got back $800. Okay, so I risked 1,050, I got 800 back. Okay, so you could say one of two things. If these go to zero, I lose $250 total. Okay, so I lowered my cost basis. Or you can say, hey, I'm already making money. I took 2 divided by 7. I took 30% profit on part of my position. Then I took another 60% profit on my next piece of my position. Okay, so when I'm trading these, okay, I'm not just looking to see the chart as well. I have to see how much stock it controls and the implied volatility. Because if a trader's buying 3,600 calls, that's 11 times usual volume. That means the volatility is going to spike. Volatility is just a supply and demand curve. So take huge profits today in QSII and SFM. But once again, guys, always taking some profits on the table and leaving some to ride, okay? That's how I trade. And if you look at the portfolio spreadsheet, I'm up almost 100% year to date. And I trade this exact same methodology of targets, okay? Always taking targets, moving to the next trade, okay? Thanks, guys. This is trading QSII and SFM for 11/5/2013. Thanks, guys, and I'll see everybody in Trade Alert or Premium Twitter land soon.